Welcome back to Financial Market Insights for Traders. I'm your host, Sophia. Today's episode is a special one because we're talking about something that every trader will face, no matter how good they are: losses, and more importantly, how to bounce back from them. If you've ever felt crushed by a losing trade or wondered why certain trades hit harder than others, this episode is for you. Let's get into it. Taking a loss in trading can sting. For many of us, it's not just the money, it feels personal. You researched the trade, you believed in it, you committed, and when it fails, it can feel like you failed. But that's a trap, because the truth is every trader, every single one, takes losses. What separates professionals from amateurs isn't that they avoid losses, it's how they handle them. Let's zoom out for a second. Even the greatest traders in history have had crushing losses. Ray Dalio, founder of Bridgewater Associates, once lost so much money betting against the U.S. economy in 1982 that he had to borrow $4,000 from his dad just to pay the bills. That loss shattered his ego, but instead of quitting, he learned from it. He adopted a radically data-driven approach, rebuilt his fund, and turned it into one of the largest hedge funds in the world. Paul Tudor Jones, another legend, once made a catastrophic cotton trade that nearly wiped him out. But he used that experience to build a system rooted in risk control. He decided never again to risk too much on any single position. That one loss redefined his entire approach to trading. And it worked. And then there's Jesse Livermore, a pioneer in trading from the early 20th century. He made and lost multiple fortunes. His story is a roller coaster of wins and wipeouts. But what we remember him for isn't just the money, it's the lessons. He showed us that emotional discipline is just as critical as market knowledge. So what's the point? One loss doesn't make you a bad trader. It's a rite of passage, a lesson in disguise. So why do losses hurt so much? It's deeper than just financial pain. Neuroscience shows that losing money activates the same parts of the brain as physical pain. That's why a bad trade can leave you feeling nauseous, tight in your chest, or even lightheaded. Your body literally reacts as if it's been hurt. And when that pain mixes with regret, especially if you broke your own rules or acted on emotion, it hits even harder. But here's the key: emotions are normal. Feeling bad after a loss doesn't make you weak. It makes you human. What matters is how you respond. Let's talk about how to bounce back. First, detach your self-worth from your trade outcomes. You are not your trades. One bad call doesn't erase your potential. Professionals don't judge themselves by whether a trade wins or loses. They judge themselves by whether they followed their process. Did they stick to the plan? Did they manage risk? That's what matters. Next, review your trades, but without blame. Ask, was this a bad decision or just bad luck? Did I follow my plan? Did I overlook key signals or let emotion lead the way? This kind of review isn't about shame. It's about learning. And when you learn, you grow. It's how you turn losses into stepping stones. Now, I can't stress this next one enough. Journal your trades. All of them. Every entry, exit, reason, and this is key: how you felt. Over time, you'll see emotional patterns. Maybe you overtrade when you're stressed, or maybe you panic sell after one loss. These are emotional investing decisions, and journaling helps you spot them before they become habits. Another tool that helps: the Fear and Greed Index. This market sentiment gauge tells you how emotional the crowd is. If the index shows extreme greed, it's probably not the best time to jump in. If it shows extreme fear, maybe it's time to look for opportunity. Use it as a check-in for your own mindset. Let's talk about resetting your mind. After a bad trade, it's tempting to win it back. But revenge trading is a fast path to blowing up your account. Instead, take a break. Walk, meditate. Read.do something that clears your mind. The goal isn't to suppress emotions, it's to manage them. And here's the biggest shift: stop trying to predict the market. Focus instead on building a process. Your edge isn't your ability to guess what happens next. Your edge is the consistency of your process. Backtest your strategy. Define your entry and exit rules. Use stop losses. Manage your position size. A process is what protects you from emotional chaos. Now, let's talk about FOMO, the fear of missing out. It's one of the most destructive forces in trading. You see a stock exploding, everyone's talking about it. You feel the pressure to jump in. But by the time you do, you're often buying the top. FOMO trades are emotional trades. They usually lack planning, and they often end in regret. To avoid them, use limit orders. Set alerts. Wait for pullbacks. Create a watch list with clear entry criteria. Trust that the market will always offer another opportunity. You don't have to catch every move. You just have to catch the right ones. And now, how do you become a disciplined trader? Start with rules. Set your stop loss before the trade. Never risk more than 1 to 2% of your account on a single trade. Avoid trading when emotional. Don't chase. Don't double down after a loss. Discipline isn't a trait, it's a habit. You build it one decision at a time. Let's do a quick QA before we wrap up. Why do I panic sell during dips? Because you're either risking too much or trading without a plan. Reduce your position size and clarify your exit strategy. How do I stop feeling regret after a trade? Focus on process. If you followed your rules, there's no reason for regret, even if the trade lost. How do I overcome fear after a big loss? Start small. Use a demo account or micro trades. Rebuild confidence with structure and repetition. Why do I always sell too early or too late? Because you're reacting emotionally. Define your exits up front. Use trailing stops or partial exits to balance risk and reward. Let's close with this. Losses are tough, but they don't have to define you. They can make you smarter, stronger, more focused. You just have to choose to learn. Want more help with your trading mindset? Subscribe to the Crystal Ball Markets podcast. We dive deep into trading psychology, discipline, and real world strategies. And if you're looking for a platform that supports you with real time data, demo accounts, and helpful tools, check out crystalballmarkets.com. It's built for traders who want to grow with intention. Until next time, stay grounded, stay sharp, and don't let one bad trade keep you from becoming a great trader.